Francis is a beautiful, beautiful church. I mean, it's one of the more beautiful churches I've ever been in.
Well, Sailor, are we ready to go?
I think we should get going,
Great.
Tom. I think
Okay.
we have
We will
good
start. Great. We'll start right now. So welcome to the webinar hosted by Catholic Investment Services. Thank you for joining us today. Our topic is the role of alternative investments in Catholic institutional portfolios. My name is Tom Lanctot, and I'm privileged to serve as the Chief Executive Officer of Catholic Investment Services. My colleague, Zayla Astarjian, who's done a great job organizing this program, is at the Zoom control panel. Enormous thanks to our Hall of Fame panel, which we will meet shortly. Today's format will be conversational, and CIS Board Chair and Notre Dame investment legend, Scott Malpass, will act as moderator. There'll be time for audience questions after the formal part of the program, so please use the Q&A feature, not the chat feature. Please use the Q&A feature on your Zoom screen to submit a question. Our audience is muted, and the call is being recorded. Catholic Investment Services was founded by some of the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit serving other Catholic nonprofits. We hope this webinar provides some useful take-home value. You received biographical information for our speakers, but I want to add a few additional comments. CIS co-founder and board chair Scott Malpass recently retired as Chief Investment Officer of the University of Notre Dame, where for 32 years he was responsible for investing the university's endowment and other assets of over $14 billion. Notre Dame's endowment is the 7th largest private university endowment in American higher education and the largest at a Catholic university. Institutional Investor magazine has called Scott an investment titan and MVP, and he certainly is all of that and more for CIS. Notre Dame tennis legend Rick Buhrman is a bit of a Renaissance man. In addition to his athletic skill, Harvard MBA, and impressive work with the Notre Dame Investment Office, Rick holds a graduate degree in theology from Oxford University. Rick teaches a course at Notre Dame's Mendoza College of Business called The Art of Investing, and it receives the highest student rankings in the college. Rick and his wife have also been foster parents. Steve Schott is another legend, particularly among Catholic institutional investors. His team at CapTrust is routinely recognized among the most accomplished and respected consultants serving institutional clients. Like our other panelists, Steve is a man for all seasons, having served as Chief Operating Officer of the Cincinnati Reds, a trustee of the Pro Football Hall of Fame, a member of the BCS Orange Bowl Committee, and board and investment committee member for numerous athletic, civic, and religious organizations. Steve also brings some academic balance to our panel, having graduated from Denison University, where by coincidence, my two sons graduated. Before our program begins, please join me in a short prayer. Dear God, please grant us the serenity to accept the things we cannot change, the courage to change the things we can, and the wisdom to know the difference. Please specially bless all those whose lives have been so disrupted by the pandemic, and help those of us who are merely inconvenienced realize how lucky we are. Amen. Thanks to our exceptional panel. And Scott, let's get going.
All right, thank you, Tom. And good afternoon, everybody. I'm the least important person on this panel today. I want to say that up front because I'm with the Secretariat of Consultants in Steve Schott of CapTrust. And since Rick did play tennis, the Roger Federer of investment directors. So I'll just throw a ball out to each of them and we'll have a fun time. So, look, my whole career, alternative investments has been a huge topic. Certainly we were a pioneer at Notre Dame in investing in some of these areas, which means we also know all of the risks and pitfalls and challenges of having an alternative portfolio. I know we still use the word alternatives to describe things like private equity and hedge funds, but they're not really that alternative anymore. I'm not sure what's alternative because everybody's doing them. But I think the industry still likes to use that name. But for example, in private equity 30 years ago was really a cottage industry. And I think in the early 90s, there might've been $75 to $100 billion managed in private equity funds. And today you're probably closer to 5 trillion of global private equity assets under management. That's a pretty staggering increase. So much more institutionalization than in the past. There's actually more PE-backed companies, private equity-backed companies in the United States today, maybe around 8,000, which is more than the number of listed equities on public exchanges, which are under 4,000. That's another significant change. The number of active private equity firms, general partners, has doubled just since 2005. So a lot of changes in the industry, and as Steve Schott will tell you, that there's significant weightings in various institutional portfolios in private equity. And the same is for hedge funds. I mean, I think in, say, 1990, there were less than 1,000 hedge funds. And now there's probably 10,000. I think it actually was higher a few years ago. And it's not unusual for institutional portfolios to have 20 to 30% in hedge funds. In fact, prior to 08, there were institutions I was aware of had close to 50% in hedge funds. And now some of that's come down in favor of other things. But we'll talk about that. And of course, there's real estate and other areas. One of the things that gets a lot of conversation today is, sort of the 60-40 plain vanilla portfolio versus the endowment model. And again, the endowment model really is just a more equity leaning, diversified approach where, people recognize that having some illiquidity could provide extra alpha to a portfolio if you have the right investments. But when you think about 60-40, it has been a tough benchmark, particularly if the 60 is the S&P 500. That portfolio has probably done about 10% a year over the last 10 years. And that would be higher than most institutional medians. If the 60% equity piece is a global portfolio, it's not quite as high a bogey, but still significant. So a lot of investors are sort of thinking through that. Is it worth paying the fees? Is it worth having the staff? Is it worth all the headaches to invest in alternatives? So I might just throw it out to Steve to start, who spends a lot of time thinking about this for his clients. How do you think about this, Steve? And what sort of advice do you have?
So Scott, first of all, thank you again for having me here today. And it's interesting, you and I, when we started and Rick, Scott and I are going to age ourselves a little bit, but when I was started in business in the early 80s, you can get 15% on bonds.
Yeah.
And today, a 10-year, you can barely get 1%. And this has certainly been a great bull market for total return, but in terms of bonds carrying their weight, it's not looking that it'll happen in the near future. On the other side, equities have had a tremendous run as well, particularly U.S. large cap equities, and the valuations are certainly on the richer side. I don't think there's anyone out there who's going to say that equities appear cheap right now. So we're at a point where, yes, that 60-40 has worked well, but as we also know, market cycles change, and that different leadership comes in. And looking forward, and particularly when you have, as we said, a higher valued equity market and a low fixed income market, the capital market assumptions or expectations, as we call them, are looking at other asset classes. And in the alternative world, as you all are very versed and experienced in, this is an opportunity to add some things. Granted, in the alternative is, as Scott pointed out, it's a very diverse world and it has grown terrifically. There's certain areas we like over others, but Rick, I'll pass it to you and ask your thoughts.
No, Steve, I agree. Maybe I'll just add a couple more elements to it. If you think about the 60-40 and the nature of how most of these major indices operate and what institutional investors follow, by and large, they're market cap weighted indices. And so what that means is that when you find yourself on the other side of a bull market run for arguably 10, or in the case of bonds, 30 years, you've got tremendous concentration. You could argue whether it's too much concentration or not, but it's certainly the 60-40 has never been more concentrated than it is today. And so, it just makes the case that if you can find, of course, it has to be the appropriate form of diversification, but good diversification has never been more valuable.
And Rick, an interesting stat I'll throw out there is, as September 30th, with the S&P finally positive at 5.7% for the year, if you take away Apple and Amazon, that total return for the whole rest of the 498 stocks goes to about 20 basis points.
And that's, we might have some time to talk about this later, but I think one of the, there's been some really interesting research that's emerged just about stock market investing. Most of it came out of a researcher from Arizona State just about 4 or 5 years ago, dissecting the nature of returns at the security level for the U.S. stock market over the last 100 years. And what they found is exactly what Steve just described, which is that about 3% of all U.S. securities have more than driven 100% of U.S. stock market returns. And I think from that flows a couple of really interesting, bits to mull over as an investor of any kind, really. First of all, it means that actually equity investing is not dissimilar from venture capital investing. And so if you're gonna participate as an active investor, you better be able to think that you have an edge and think that you're going to be able to identify, or that your managers are going to be able to identify some of those long-term winners, and then be positioned to be able to hold on to them. Otherwise, you're probably, your best bet is to just hold on to the indices. But the key, as we get into one, I know we're going to talk more about alternatives, whether it's private equity or hedge funds or anything, is this whole notion of doing something a little bit differently, paying attention, being aware of what the market generally offers you over the long term, which is tended to be in mid to high single digits, and being able to do something special, using maybe some other vehicles to do it, but doing something that actually can add value and is suggestive of creativity. And I think those are really key tenets. As anybody looks to try to explore the world of alternatives, you want to make sure that you're finding people that really have that edge, have that kind of that mission of doing something truly excellent, not just diversification for diversification's sake.
One of the things that investors who end up throwing in the towel, let's say on alternatives, or decide they want to go back to a 60-40 portfolio, they focus on costs. And of course, costs are important. It's something that should be factored into any investment decision. Steve, how do you advise your clients on that balance? You're going to, obviously, alternatives are more expensive. You pay for what you get, and the best managers are worth it.
Well, and you're absolutely right. And at the end of the day, the top quartile managers in many of these alternative asset classes stay top quartile, unlike traditional equity managers where it seems to go in and out of favor over time. One doesn't want to step over dollars to pick up pennies. And my point to that is, if there's a particular manager that adds value, particularly in the alternative space, then you have to look at what the net return is. And we've looked at different parts of the alternative spectrum. Yes, we've had traditional equities and fixed income as a consultant, but we also look at parts of for example, private equity world. We look at the real estate, and again, these are also emerging. Different factors are hitting them fundamentally, and looking at valuation. So, and the hedge funds. I mean, hedge funds. Yes, we've been traditionally light there. However, it's getting interesting again. Where all the money flowed into it, we kind of believe that it took some arbitrage opportunity out of there. But as we see what's developing now, and again, relative to the valuations, we're reconsidering that look, and obviously we want to do it with the Catholic values as you all have.
Rick, you really led the country in many ways in really pushing for alignment between general partners and limited partners, particularly in the hedge fund space. How did you think about making sure investors had the proper balance there and the proper alignment in terms of the costs?
Well, I mean, I agree with a lot of what Steve said, and you and I have had a lot of fun thinking through this over the years. The way I would summarize it would be pursue alignment of interests without being dogmatic. Sometimes you pay for what you get in investing, just like anything else. And much in the same case of luxury goods, sometimes things cost a bit more that are worthwhile to you. But I do think that underpinning the notion of fees is something that's much more important, which is how are the interests of the GP and the LP aligned? And the reason that's important is not because you're at any given time wanting to minimize the fees you pay, but what you're trying to do is create a scenario whereby when you as an investor do well, the GP, your partner, does well. But conversely, when things don't go the way that anybody wanted them to go and there was underperformance, that's reflected in what you're paying. So there's a lot of ways that I think are coming to light in terms of how a partnership can structure itself to be able to pay very good fees when the outcomes are very good, but also minimize the fees paid when outcomes don't meet the standards of either the LP or the GP.
Do you want to add to that, Steve, at all?
I'm sorry, Scott, you went out for 1 second.
Sorry, do you want to add to that at all in terms of that alignment?
Yeah, yes, I think it's very important as we're chatting here today. Clearly, when you have size and experience and relationships like you all have, and we're looking the alignment to be with the Catholic values, that's really important, not only to keep the fees down, but also to be consistent with what our clients with the Catholic institutions are looking to do. So no, the alignment we think is absolutely critical in this process, not just fees, but also for the Catholic investing, Catholic folks.
Steve, you might just continue and talk a little bit more about, from an asset allocation standpoint, how do you think about alternatives with your clients, and what are some of the categories that you recommend to them?
So again, recognizing that the alternative space for Catholic focused up until, for example, the advent of your program and some others have been very limited. And that's a blessing that you all have decided to go into this area and expand upon that. The areas to which many of our clients have looked is private equity, but again, you have to get with a GP there that can at least invest with the Catholic values. And you all have a lot of experience there. Many of them won't give you that kind of affirmation. The real estate, different types of real estate. Again, real estate in the commercial, there's government, GSA, there's some niche properties, but the real estate, private equity have been two major areas that we've looked at. Private credit has been an area to which has been cyclical, but over time has added value. And again, although been light on the hedge fund side, it's an area to which is becoming interesting again.
Yeah. Rick, you've highlighted that there's actually been a bit of a convergence between public and private investments. What exactly does that mean for institutional investors?
Yeah, I think you're seeing more and more investors who are asking for the full flexibility to invest in both public companies and private companies. And it's not entirely new. I mean, even going back a decade, there were examples of some of the major mutual fund houses beginning to participate in private equity rounds. I think there's a couple of reasons why it's happening. One of them is I think just basic supply demand. When you look at the numbers, private equity, Scott, as you suggested, has gone from this cottage industry, very, very inefficient, and has itself had an extreme bull market. I mean, if you look, I know Scott and I, over the last couple of years, we're looking at data of institutional investors by asset class, and it was pretty staggering to see that essentially all institutional investors, or the vast majority of them, have been able, with their private equity portfolios, to outperform public markets. And so there's been a number of tailwinds for private equity that should exist. There's a number of advantages. And as folks have seen those results come through over decades, both GP investors and LP investors, they've naturally said, hey, I might want to take a look at that as a means of outperforming, of helping myself to outperform. There's another important element, though. We've talked about all this disruption that's accelerated over the last 2 decades, but even this year, with the pandemic, we're seeing just extraordinary disruption of business models mainly as technology and data become ubiquitous with business. When you're looking at an industry, if you're a public investor, today versus 15, 20 years ago, the private equity markets are so mature. So much of your competition, so much of your suppliers, so much of other constituents that relate to the public companies that you're actually interested in are private. And you have to be aware of that. You have to be you have to pay attention to that. Similar, if you're a private equity investor in say areas of technology or biotech or even more traditional industries, you just have to have a full awareness of the entire ecosystem. And so, stepping back and just thinking about, what the differences are, there are liquidity differences, which could relate to structural issues with whether a liquid fund like a mutual fund, how much illiquidity can take. But in terms of underwriting a business, there's very little different from owning the equity of a public business and owning the equity of a private. So I think it makes perfect sense. What it means for investors is, I think it's time to again kind of start thinking about experimentation and creativity, because historically institutional investors have been known to favor silos and bucketing various asset classes or even sub-asset classes, and thinking about their managers as playing a very specific role, and that's it. And on account of that, I think a lot of institutional investors are not paying enough attention to some of these really world-class, what I'll refer to as crossover investors who are investing both public and private. And I think in 10 years from now, we're going to look back and we're going to see that was a really important trend to be aware of and to be in the, in the right ways participating in.
A lot of folks are wondering how the pandemic has affected different asset classes, and particularly some of the technology acceleration and adoption that's been done really out of necessity. I mean, January, February of this year, Zoom was sort of a nice small company that didn't really stand out relative to any of the other services, and now it's a verb. So there's been a massive adoption and technology that's been accelerated. Do you want to comment, Rick, on that a little bit and how it's affected different asset classes, Rick and Steve?
Sure. Maybe I'll start, Steve. I mean, I think at a high level, we're peering into the future. It's been pulled forward. I mean, we've all been forced, every business and every individual has been forced to think about how we digitize our lives, because we don't have a choice, whether it's the purchases we're making, the services that we're consuming, or the way that we're all doing business ourselves or trying to conduct our work. It's been thrusted into this world where we're at. And Zoom has obviously been a very powerful bridge, but you can look at that across any manufacturing business or any other kind of product or services businesses. So what I think is happening is adoption of technology, tech enablement is accelerating because of necessity. It was already happening, but it was happening slower. And I really think where we are today is where we would have been maybe 3 or 4 years from now. I'll give you one example. Zillow. The way in which real estate is being bought and sold has historically been highly inefficient. Everybody here has probably either been involved in buying or selling a house and understands the inefficiencies with the model. Zillow is also, I think, very quickly beginning to become a verb of how real estate transactions occur. And why is that been accelerated in the midst of COVID? Well, because depending on where you are in the country and depending on the time of year and the seasonality of the virus, you couldn't go look at a house if you wanted to, or you couldn't have individuals come and look at your house if you wanted them to. And so Zillow's ability to create almost overnight 3D touring of homes in just a remarkably powerful way that enables people to actually make decisions sight unseen on buying and selling homes is occurring daily. So it's no surprise that and Scott, we did this a bit at Notre Dame. We bought in the midst of late March. We bought some Zillow alongside its major competitor Redfin. Both of those stocks are up 400% or 500% since late March. I'm not sure that they're overvalued if you have a long enough time horizon, because what will be really interesting is to see what of our behavior and of these changes that we're talking about, what go back to some other baseline of closer to where we were, a year ago, and what are here to stay. And I actually think that most people are anticipating the world to go back in ways that it's actually not going to. So.
No, that's great. And Steve, what are you telling your clients about this?
Well, it's interesting. To Rick's point, they say it takes 21 days to change a behavior, and now we've been in this for over a half a year. And you mentioned Zillow. There's many people I know that is kind of a pastime. They'll go on Zillow and just kind of take a break or something to follow that. And you're right. The obviously Walmart's, the Amazons, their business projection plans that for over the next 5 years, they've already met those goals when it comes on with tech and delivery. Obviously, it's changed retail as we see it. It is changed office, and it's not just changed it in the stocks in the publicly traded, but in the private companies. Obviously, we might be a little concerned about having office space right now in a major metropolitan area. But on the other side, Amazon fulfillment centers are looking quite attractive. And there's a longer term view. Yes, maybe some of these things have become a little ahead of on terms of valuation, but as you point, longer term view, this could make a lot of sense. What we're sharing with clients, we're in a dynamic world, and we want to make sure that we're proactive in being in front of this.
How much do capital market projections play in some of the advice that you give, Steve? I mean, you're a long-term, you're setting people up for the long term. We have a question already about inflation. Are you worried about inflation, for example? And if so, would you invest in commodities, farmland, timber? How do you think about that?
Well, a couple of questions within that, and would suggest that yes, with the ingredients in terms of what's gone on with the debt that's being issued. I mean, many times more than 2008 and 2009. There's more of an opportunity for inflation. We could get into more of the perspectives on that, but we think that what you do need as an all-weather portfolio to have some protection there. Flip side is there's a view that we're going to be perhaps like Japan and some other countries where we have negative interest rates and very slow growth. I mean, we could debate that, but again, from an all-weather portfolio, you need to have a little bit of that in there as well. I mean, negative interest rates aren't forecasted, but we certainly are getting close to zero. At the end of the day, the capital market assumptions have changed twice this year at our own firm and with many others. There's been, again, if you've been progressive, you had to look. The U.S. equities have front run a lot of return of what was expected in the next 5 to 7 years. And the flip side is you had, a year ago, you had a 2-year, 10-year, and a 2-year, 1 year, and now, you have de minimis on the 1 year and half of that on the 10, and you again need to adjust these. The areas of alternatives, those returns in some areas like real estate and private equity, depending on large or small or what you're looking at, developed or venture, those capital market assumptions have changed as well with the amount of money coming into there.
And thinking about real assets and inflation hedging, we've always had some investments in that area, but it's a challenge for investors, right, Steve? I mean, the vehicles aren't particularly good. There's not good alignment in a lot of those areas in terms of really implementing a portfolio in real assets, whether it's commodities or energy or timber and farmland, et cetera, or derivatives, for inflation protection. So we've always been very careful there. And really, I guess ultimately we believed equities was the best long-term inflation hedge and tended to focus more on public and private equity. But is that consistent with your own thinking? Is that a good way to think about it?
Yeah, and timber's been a very good asset class. You're right. The access to that is not very easy. There's some large minimums and it's actually one of the few asset classes that the investment in that has been up significantly in the last 12 months, and for different fundamental reasons and tactical reasons. But I think there are always, as we point out in alternatives, there are always opportunities in niche markets. And again, being, finding those. I think that's a part of our discussion today is identifying those top performing managers in different markets where there still can add value. And that's something obviously you all are focused on. And as an asset allocation and consultant, we're focused on is finding those places and those investors like yourself to work with.
So Rick, let's drill down on hedge funds a little bit more. There's certainly a very rich history in the asset class, probably beyond the scope of our call today to go through all of that. But maybe a little discussion of the history and some of the advantages and disadvantages of different kinds of hedge funds and what role they play. When I first started investing in hedge funds, there weren't that many. The best ones really did have some research advantages. There was less regulation related to research, and if you were willing to do put in the kind of efforts they were, you could get information that would give you an advantage over the rest of the market, and they were able to execute on that in various kinds of credit funds, multi-strategy funds, merger arb, long short. But you have a lot of history in this now. Maybe just talk about some of that.
Sure. I think it actually is worthwhile to just take a minor detour into history, even going way further back than just the last couple of decades. Some of the tenets of hedge fund investing actually reside in antiquity, and I'll come back to that in a minute. Most people think that the first hedge fund, as the term was coined, was founded by a gentleman named Alfred Winslow Jones in 1949. He was actually an Australian-born individual, very much a fascinating guy, a Renaissance man, not a Wall Street guy. Cut his teeth in journalism and in the wars, and a lot of time traveling around the world. But in 1949, he decided to, after studying different forms of investors, decided to build a new form of a partnership. And again, I think thinking about what the tenets are to hedge funds, one of them is just the legal entity. And by forming this partnership in a unique way and limiting his number of LPs, it gave him certain flexibility to avoid some of the regulation at the times. What are the really important tenets of what he actually did? I think one of them is just the spirit of wanting to add tremendous value over what markets were giving people. He saw an inefficiency, and that was his starting point. It wasn't just diversification for diversification's sake. It was, how do I go out and just do tremendously well by doing something differently than what everybody else is doing? And that's exactly what he did. Now, what did he use in order to do this that was somewhat novel? Short selling was at the core, essentially borrowing shares from people who owned stock to then sell them as a means to basically bet that these companies' share prices would decline. And he built a portfolio of both being long and short companies, and that introduced another really important tenet that carries forward in terms of defining really many hedge funds today, which is utilizing different forms of leverage. Ultimately, he managed a portfolio. Say, if he was managing a portfolio of $100, he was investing at any one time more than that $100, both long and short. So he was able to build essentially the first market neutral portfolio in a way that ultimately led to tremendous results. I think he outperformed markets by something like 20% a year. After a number of years, I think it was in the mid to late 50s, people started paying attention. And there's a woman named Carol Loomis, who some of you might recall that name. She was later on made famous because of her long-standing relationship as the one journalist that Warren Buffett trusted and developed a friendship with. Carol Loomis was writing for Fortune, and there's a great article about Jones that she wrote, which is, I think, entitled something like "The Jones That Nobody Keeps Up With." And it details how he built this very novel partnership that was absolutely killing all other investors and killing the markets. Fast forward, one other really important tenet to this was how he set up his fees, which was what we would refer to as 0 and 20. Now, this actually goes back to antiquity and the Phoenician merchant ships. The captains of these ships would legend would say that the captains of these ships would keep 20% of any successful mission. And that is what Jones felt if he could generate really strong returns, what he would be due. 0% management fee. If he didn't make money, he didn't want to get compensated. Fast forward a few more years, I think it would have been in 1956, and a young man named Warren Buffett essentially took many of these tenants and employed them to begin the Buffett partnership. Now, I think the question to sort of ask about why any of this is relevant is how many of these tenets are still apply today. And I would just offer that there are plenty of examples of folks who are employing those tenets in a way that could be really attractive. But by and large, I think this is where the industry has gone wrong. By and large, the industry has lost sight of this idea that actually the goal here is to do extraordinarily well. And that's, I think, Scott, what we've, spent the last 15 years trying to figure out and sort of, not to go back to a biblical analogy, but sort of separating the wheat and the chaff. Who is it that's sure is going to offer you diversification, do something novel, do something different, but at the same time, do it with an expectation of extraordinary, outcomes over the right time periods. And then the other one is the alignment piece. How many 0 and 20 managers do you find? I think at one point Buffett even introduced a hurdle rate, a hard hurdle rate to that. But those are the tenets that now we look for is something where, again, if outcomes are great, then the manager is compensated. But the 2 and 20 is a heads I win, tails you lose model that we've always shied away from. But unfortunately, it's become still way too common in the industry. So maybe I'll pause there and see if Steve wants to add anything.
Rick, absolutely. Let me underscore something you said, and a reason that I think hedge funds have been challenged over the last few years. The inefficiency. When the individual went into this, he saw inefficiencies in the market. And I oftentimes will use the metaphor to say that, or the analogy that it's like fishing. You go to a lake, and if you're the only person fishing on that lake, you do rather well. Depending on the size, if it becomes very overcrowded, the opportunity set is dramatically changed. And I think that's where we are today. There are opportunities out there. However, people need to have the experts, like yourself and we look as consultants to find those opportunities that are, I won't say overlooked, but people are still fishing in those places where you can add value with alignment. The fees, as we say, have gotten out of hand, and it's time for those to get more in line with the investor. And then you add the complexity of making sure the managers are working in a Catholic, socially responsible manner. It's something that the typical investor can't do. But again, the opportunity exists from this call to find avenues to do that.
Rick, there was a question about sourcing investment partnerships and ideas. Maybe just a brief comment on how you thought about sourcing new ideas and different partnerships.
Sure. Yeah. I mean, I think some of this comes back to Steve's point, and we ourselves as investors are fishermen and women. And we need to think about where we're, which pond we're bringing our rod to. I think a lot of the fun and also the challenge of investing and sourcing specifically is how you employ creative efforts to find people that don't always necessarily want to be found. There's ideas, there's big managers that are established, and those who have already had very successful track records and are being marketed by the banks and other third-party service providers, et cetera. And it's not to take anything away from that group, but that's a pond where there's a lot of people fishing in. And over time we've tried to use creativity, but also technology to try to surface ideas of people who are actually adding value. Now, there's a lot of great places to start from. I mean, first of all, a lot of information about partnerships is actually publicly provided through filings, and so we've studied filings of investors to see sort of in hindsight who was very early to some great investment opportunities before they were maybe more obvious. That might be a good reason to reach out and try to have a call with with an investor that maybe we hadn't known before. Of course, a lot of this is a flywheel where it's, the ideas ultimately start coming through an ecosystem of relationships that one develops and that a team develops. And so you start to find a few really great investors and partners, and then they know exactly what you're looking for, and they tend to almost act as extensions of your team. I do think there's no way around it, and this is an unfortunate one more unfortunate component of COVID. But having boots on the ground and going and meeting people, and one of the things that I've tried to do over time is evolve my travel and who I spend time with, not exclusively just with prospective managers, but when I go to a new country, for example, or even when I'm traveling here in the States, I try to meet with more companies, try to understand who these company executives think are their best long-term shareholders. It helps me to touch the medium of the investments that we're ultimately making, but it also sometimes has led to some interesting ideas. I give you one example. As Tom mentioned, I teach a class, and we were fortunate this past semester to have Jeff Wilkie, the number 2 of all of Amazon, join us. And Jeff built what all of us more or less know as Amazon, the global consumer business, everything outside of the cloud business, AWS. It was a very simple thing to do, but just ask him who he and Jeff Bezos admired the most as shareholders over the last 20 plus years at Amazon. One of the individuals that he mentioned is actually a 31-year-old young man, and it's just a very I would have never, just something you would have never suspected. Not necessarily the largest investor of shareholder or the longest term investor shareholder of Amazon, but ultimately these operators are extremely talented, and they're very good at distinguishing people who know about their business and people who don't. So I think ultimately that's become probably my favorite source, is just getting right to the heart of these operating companies that I respect the most.
Steve, there's a question to you, just asking about what you're looking for in an alternative manager who abides by Catholic social principles. What are you looking for?
So we tend to use the Catholic principles of the U.S. Catholic Conference of Bishops, and that's what most of our clients want us to use. And we want to keep in adherence to that. And again, it takes a manager in private equity world. And I believe you were asking that specifically to private equity. Is that correct?
Just generally, I think.
Generally, no.
Yeah.
In each situation, you have to evaluate it and get alignment, as Rick was pointing out earlier, in terms of commitments. But it's an area that, over the last 40 years, I found that there's very few people who did that at the beginning, even in traditional equities. Now that seems to be omnipresent in traditional equities, but when it comes to alternatives, there's still very few people that will do that. And again, to Rick's point, and your point, and your experience, it's about, just, being out there, meeting people, it's relationships. Yes, there's some technology to funnel things down, but at the end of the day, you need to be out there and identify them. And again, you all have brought a lot to the table in terms of getting your resources together as well to identify these managers.
Screening for Catholic principles, it really takes a lot of time, and the implementation of that across asset classes, it's a lot of monitoring. I mean, I had basically 2 full-time people, at least a person and a half, doing that. As you noted, Steve, earlier, each asset class was different. And hedge funds, the more pooled, opaque funds, were obviously the most challenging. It wasn't really that big a challenge in private equity, honestly. Certainly not really in real estate either, but in equities, fixed income, hedge funds. But this is something that Catholic Investment Services helps solve. That they have a process for that monitoring and review, making sure that we have a full implementation of Catholic teaching. There's a question also about ESG principles and how you think about ESG and how that meshes with the implementation of Catholic social teaching. And are we actively seeking companies that adhere to those principles, or are we just avoiding them? Maybe Steve, you've thought a lot about this over the years. You might comment on that a little bit.
Well, I'd like to share a story of back in the early '80s when I was asked to find some good Catholic investment managers on the public equity side, and I was very new into business and not aware of the specifics, and came back to the client and said, yes, we have a manager that won't invest in alcohol, gaming, and some other things. And they said, you don't realize that, you know, is the Monsignor said to me at the time. He says, you don't realize, you know, that's not a challenge we have. We wouldn't have our bingos and things like that if it wasn't the case. And I got into this world because of that. I was like, well, where do you go? Where do you find that? And oftentimes say that we were in ESG before there was an acronym. But the reality is ESG, now that's, you know, the Catholic area, the Catholic focus is a subset of that. And there's even subsets of the Catholic focus. ESG, we're I won't say we're a drop of water in the bucket, but there's so many areas and focuses of ESG in so many ways. And candidly, it's like alternatives. It's everyone is unique in how they look at the ESG. So they're obviously for environmental and social and governance. Those are important to everyone, but how they proceed, and they either exclude companies or invest in companies with impact or vote proxies. There's just a number of ways to address this.
Yeah, and there's not really a uniform set of metrics to evaluate it, and that's confusing to investors. And we've certainly seen that. You know, some of the banks and the big asset managers have really turned it into a commercial opportunity, but I'm not really convinced that some of that product is actually very ESG compliant based on what I've seen. I think things are getting better and we're getting to more standard metrics, but I would just caution the audience when looking at some of that product just to be careful and make sure you're asking the right questions. Maybe just moving forward in the interest of time, you know, how do you execute on alternatives? I mean, you know, we're working with Catholic investors of all sizes. This is a question their investment committees are thinking about. I know there's a lot of confusion about what's included and how you do it and how do you access the best firms. What advice do you have, Steve, for prospects and clients about how to really execute on alternatives?
So first of all, each client is unique, and you want to have them start off with what their objectives are, whether it's an endowment or a pension. You know, everyone has different time frames. Everybody has different liquidity needs and cash flows. So we have to start off from there and set an asset allocation, a strategic asset allocation. You can look at some tactical allocations as well. And for the diversification on the risk and the return, and as we say, this is a dynamic program. You want to look at all the available options out there. And so when it comes to the alternative point, and if it makes sense, you look at, you know, do we do individual managers? Do we do a fund of funds? Do we do a combination? And that a lot of times that depends on size. I would say in general, not absolutely, but the larger tend to look at individual programs. However, there's always an opportunity for good, strong fund of funds. It's almost, I won't say exclusive, but if you're going to be in smaller to mid-size foundations, endowments, pensions, they need someone to, you know, once we set that allocation, we need somebody to implement that. It's typically through a fund of funds, and having the alignment, again, like yourself, that becomes a very attractive option.
I think it's really important because if you look at the data, the average of the alternative stuff, whether it's private equity or hedge funds, is actually not very attractive. It's pretty poor. So you really need someone who's really expert in this, who can really give you access to the top group with all the various restrictions that you require. I mean, when you think about fees and terms and leverage and risk management, all of these things have to be evaluated. It's a lot more complicated in this space than in long-only equities, right? And so
Absolutely.
It requires real oversight. Do you want to add to that, Rick, at all?
I just, you know, I think one thing that institutions understandably fall prey to is this kind of real fear of missing out and an undue sense of urgency to get something done. And because of the complexity of this, I would just encourage people to really sort of internalize the time horizon that your institutions have. And for most of them, it should be quite long. And if that is the case, there's an opportunity to step back and do this methodically. A friend of mine many years ago told me something that stuck with me, which is that human behavior is such that we systematically overestimate what can get done in a year and underestimate what can get done in 10 years. And I think that's so true in investing. I think that this urgency to be transactional and to show that you've accomplished something leads people to take on a project like this way too quickly. But if you could put 5 to 10 years aside and say that over the next 10 years we're going to become experts at alternatives, I don't see why it's not doable. Particularly because nobody else out there is employing that time horizon. Everybody else, unfortunately, is exhibiting more frenetic behavior. And so I would just say, look, if you do have a shorter time horizon on account of your institutions, that's one thing. But I think the majority of folks really do have the flexibility and the freedom that time confers.
Rick,
Let's hit a couple. Go ahead, Steve.
if I can underscore something you said there, if you generally look at all the studies and from just firsthand experience, if you look at those who have longer, not only time frames, but don't have that frenetic that they need to be doing something or they need to change something, the more people let investments be investments and not trading, the better the returns those funds have had by a nice margin.
Yeah. Rick, there's a question about SPACs, which the question is, SPACs appear to be the new thing. How do you think about these as part of your asset allocation? Would you consider these alternatives?
SPAC, for those who aren't familiar with the acronym, it's a special purpose acquisition company. And they're not necessarily new, but they have become a lot more popular for various reasons here in the last year. There's a lot of great literature out there. I think they're getting again, I think they're being oversimplified. Essentially, the way I see a SPAC is a new way to for a company to become public. And my overarching view on that is the current system of how companies have historically gone public is actually pretty bad. And it actually hasn't been evolved very much in the last 50 years. And it needs evolution. So if you start with that standpoint, I can understand why SPACs are occurring. For those who want to dig into it, there's a friend of mine and of Scott's is a gentleman named Patrick O'Shaughnessy of O'Shaughnessy Asset Management. I think he has the best investing podcast out there. It's called Invest Like the Best with Patrick O'Shaughnessy. And not too long ago, he had Brad Gerstner of Altimeter, again, probably one of the most best performing crossover investors out there. I think he made $3 or $4 billion on his Snowflake investment alone at the IPO here. Alongside Rich Barton, the founder of Zillow. Actually, I didn't think that was going to come full circle. But Brad and Altimeter are actually out in the market with a SPAC. And I think the way he describes it, I think is really useful to understand that much like everything else, there's high quality SPACs that are out there, and then there's a lot of junk. It's like there's an opportunity. So a lot of people who maybe don't have the best motives have jumped into this. But I think there are some SPACs that are really interesting, and ultimately it comes down to people. So with a SPAC, you're essentially backing a team to go out and find an asset and take it public. And by and large, that's what investing is all about: is basically finding high quality people to do things with. So I don't have anything against SPACs. There certainly would be a small handful I'd love to invest. I don't see them as an asset class though, but more just a mechanism for a company to go public.
And Scott, if I follow on what Rick was saying, when we were back talking about private equities, I actually thought about SPACs because I was going to, the comment that put a light on for me years ago was most public companies were private equity companies at one time. And then I thought maybe the exception of SPACs these days, but I don't look at it as an asset class. I think Rick, you articulated that with our same view.
I agree. No, I agree. There's a question on the USCCB guidelines, which are being updated now to reflect some of the modern terminology and movements related to ESG and stakeholder capitalism, et cetera. Question is, are you advising them on how to do this well now that alternatives are a much bigger factor? And I'm not sure who the you is, maybe it's Steve or maybe it's CIS, but we certainly, he's saying we're pros, so we know their area. I'm not familiar that CIS is doing anything formally with the USCCB. I can tell you at Notre Dame that there were representatives in my office that were helping the Vatican think through a policy that's not been articulated or made public yet. But the Holy See is at least considering, having some sort of social policy that is not only for their own funds, which they do now, but to have something common, but also that could be a template for the world. But Steve, are you doing anything formally with the USCCB?
Well, and we hadn't talked about this previously, but through the Mendoza School, I was invited several years ago to speak in Rome. We had a trip to the Vatican on impact investing, and through Dr. Wu and Catholic Relief Services. And at the end of the day, impact investing is certainly growing. There's a significantly growing interest. To our earlier comment on ESG, by the way, tie that in. I have suggested over the years that the ESG and the social investment trends have kind of gone in and out. I believe it is here to stay. I said that over the course of the last year now. This is not a trend anymore, in and out of different people embracing it. I think this is here to stay. And the impact investing, there's a lot. We could do a whole nother talk on this. But yeah, I think there's a lot of areas there. And what's going on with the latest developments is we're going to share for the USCCB, looking at energy and how to deal with that. There's a lot of interesting changes, I think, in the future.
Scott, if I could just add one thing, I understand the sense that that the USCCB would need help of investors to do their job well. I actually think it'd be better, and I assume this is happening, but I actually think that the better advice will come from industry. If you think about the complexity of some of the questions they're facing around life issues and the life sciences, and when where things are going with biology and data science, or even in energy. I think those are the experts that really, of course, nobody's asking me, but to me, I think it would be wonderful to see industry play more of a role with the bishops in sorting that out, rather than investors.
No, that's a good point. Before I turn it over to Tom and Zayla, let me just thank Rick and Steve for really a great discussion and for their hard work in these areas and supporting Catholic organizations over many, many years. So thank you both for just a great discussion. I will add that CIS, Catholic Investment Services, does have an impact investing fund, a private equity fund. We're launching our second version of that in the coming year. And we're also launching a diversify hedge fund of funds in January. And Tom and Zayla may want to say more about that, but thank you all for listening. Tom?
Let me just add my thanks to Steve and Rick and Scott. I think we unfortunately ran out of time, but I think we could do a couple more of these sessions. I think there's just so much content, and bringing your experience and insights has just been so valuable. So thank you for your time and contributions. I know the audience will, Rick, you'll get a high rating from the CIS audience for sure. But anyway, thanks to our and as Scott mentioned, we'll be following up. Actually, our colleagues, Zayla and our colleagues, be following up. We're going to have an ebook, sort of an introduction to hedge funds that I think will be valuable, following a pattern that we've done earlier in the year, this year, in terms of private equity and investment committee best practices. So we'll share that with everybody who registered for the program. So thanks again to our audience for joining us. Best wishes to all for a blessed and happy Christmas, and most importantly, please stay healthy and safe. And thanks again. We're concluded.
Merry Christmas.
Merry Christmas.
Merry Christmas. Thank you.
Thank you. Merry Christmas.